Confused between EBIT, EBITDA, and EBITA? You're not alone. These three can completely change how a company looks financially. Let's break it down simply. EBIT means earnings before interest and taxes. It shows the company's operating profit after accounting for all expenses like salaries, rent, and depreciation. EBITDA goes one step further. It stands for earnings before interest, taxes, depreciation, and amortization. So here we remove non-cash expenses like depreciation, making profits look higher. EBITA is similar, but slightly different. It means earnings before interest, taxes, and amortization. So it removes amortization, but keeps depreciation. Example: let's say a company has revenue 100 crore, expenses 60 crore, depreciation 10 crore, amortization 5 crore. EBIT equals 100 minus 60 minus 10 minus 5 equals 25 crore. EBITDA equals 25 plus 10 plus 5 equals 40 crore. EBITA equals 25 plus 5 equals 30 crore. Sector insight. EBITDA is widely used in capital-heavy sectors like telecom, infrastructure, and manufacturing. Because depreciation is huge. EBIT is preferred in sectors like FMCG, where asset intensity is low. EBITDA is often used in tech or pharma, where amortization from intangibles matters. So remember, EBIT shows real operating profit. EBITDA shows cash-like profitability. And EBITA sits right in between.
Subscribe for more. Disclaimer: this content is only for educational purposes and does not represent financial advice. Please consult your financial advisor before making any investment decision